But like there isn't just a single goldsmith, there isn't just a single bank. So let's assume that there are two banks, Bank A and Bank B, and let's see what issues might arise by having multiple banks. Just like before, both banks issue their own notes, hence the name banknotes, for gold deposited with them, perhaps even with different denominations, like in this case a note for a quarter and a half ounce of gold respectively. They also allow their customers to keep their money in checking accounts, which are in the most simple case entries in a ledger comprising the name of the customer and the respective amount of gold deposited by him, his account balance. Now, perhaps the most obvious problem is the existence of multiple types of banknotes, one per bank, which is obviously messy in any cash register. Paper money and checking accounts became popular because they made people's lives easier, but different banknotes diminished that advantage to a certain degree. It is also difficult to transfer money from one bank to the other, because first, one has to redeem the gold from the original bank by returning one's banknotes and/or reducing the account balance of one's checking account, and then has to transfer the gold to the other bank to gain the banknotes of, or a checking account with, the other bank. Far more problematic, though, is the notion of a bank run. In this example, A has a reserve ratio of 8%, while B has 12%, and both are solvent. Perhaps A does not expect that people would ever want more than 8% of their deposits back at one point in time, and thus it levered up its balance sheet with loans, since every additional loan means additional income. B, on the other hand, might have been a little more prudent by keeping more reserves at hand, thus reducing risk, but also missing out on potential profits. But because of A's overextended balance, B's prudence does not pay off. Imagine some extraordinary event that causes customers to withdraw 10% of their gold, perhaps a foreign trader passing through town. Now, B would be sufficiently prepared for such an event. It can satisfy all claims by its customers, and at the end of the day, it still has some gold left. A, on the other hand, is in trouble. Even if all its loans are good loans, and the people it loaned money to are guaranteed to pay it back with interest, at the moment it doesn't have enough gold to satisfy all claims. It becomes illiquid in terms of gold, and has to admit that it can't pay its customers right away, even though it claimed they would be able to redeem their gold whenever they liked. It could try to call in some loans that it made or borrow some gold from someone else, but both methods usually take time. So even though A is solvent, A is in big trouble. But the problem does not stop here. In fact, it is only about to start. Word spreads quickly that A is not able to return the gold that was deposited with it, and soon, customers of Bank B and other banks also start worrying. They rush to their banks and try to redeem their gold. After all, some of A's customers, the ones that came early, were able to get their gold back. Now B was prepared for up to 12% of its deposits to be withdrawn in a single day, but due to A's default on its promise, a lot more people try to redeem their gold, and soon, B and all the other banks also have to admit that they are also illiquid. This event, the crisis of faith in the banking system and the subsequent attempt of customers to redeem large amounts of reserves, is called a bank run. Notice that this situation could have been avoided. If A had kept as many reserves as B, nothing would have happened in the first place, and even if A had insufficient reserves, it would have been in B's interest to lend some gold to A to avoid the run on its bank. So there are various issues here. The most problematic, that a single bank that is very aggressive, even speculative with its lending, can cause the entire system to collapse, which means the system is only as stable as its weakest link. Hence, it might be desirable to define a minimum reserve ratio that all banks have to satisfy, so that all links in the chain can bear a, hopefully sufficient, amount of stress. It is in the interest of the banks to solve all those problems, and so they form a cartel and charter a new entity, a reserve bank. Continuing in our example, both A and B use some of their capital to create a new corporation, the Reserve Bank, and as the owners, both receive a part of its stock. Now, as the name suggests, the Reserve Bank takes ownership of the gold reserves. Just like depositors at a normal bank, A and B receive checking accounts and/or banknotes for their deposited amount of gold. Now, a single currency for multiple banks is born. Since those banknotes are now issued by the Reserve Bank, and therefore a liability to the Reserve Bank, their credibility is no longer tied to the destiny of a single commercial bank, such as A or B. So, instead of storing gold in their vaults, commercial banks now have reserve notes and their checking accounts with the reserve bank as their new reserves. To make the transition to this new single currency, customers of A and B can trade their old, bank-specific notes for reserve notes at their banks. In this scenario, these new reserve notes are currently fully backed by gold. So this transition is only possible if there are fewer old banknotes outstanding than new reserve notes being issued. If we were to imagine a reality where customers always demand banknotes for their deposited gold, there wouldn't be any checking accounts. Since the number of reserve notes a commercial bank can acquire is limited by the amount of gold it deposited with the reserve bank, which does not extend any loans and is therefore fully backed, it could only make the transition if its own notes were also fully backed, which is the case if and only if it did not extend any loans itself. So the existence and widespread use of checking accounts is crucial. Otherwise, too many banknotes would be in circulation. Luckily for the banks, checking accounts and checks are indeed a more comfortable form of currency, especially for larger transactions. Hence, most people hold the majority of their deposits in checking accounts and only a minor fraction in banknotes, so the transition is actually possible. With the introduction of the reserve bank, it now becomes much easier to transfer currency from one bank to another, because reserve notes are now accepted by all banks, and even cashless transfers are possible. If a customer X of Bank A wants to transfer money from his checking account to another customer Y of Bank B, he simply adds B's bank identification number, or bank routing number, to the check. Now Bank A simply reduces X's account balance by the specified amount, and in turn writes a check from its checking account with the reserve bank to B's checking account with the reserve bank. On the other hand, Bank B receives the funds from Bank A, and all B has to do is credit those funds to Y's checking account. So the entire process of transferring money from one bank to another does not require any transportation of any gold anymore, but only a manipulation of a few numbers in a few ledgers. There is still a very significant difference between transactions within the same commercial bank and transactions between two different commercial banks though. A transfer within a commercial bank from one checking account to another does not change the reserve ratio at all, since the bank just has to change its own books. But a transfer to another bank involves a transfer of reserves with the reserve bank, as we have just seen. So, from the point of view of a single commercial bank, transferring money to another bank has the same effect as withdrawing it. It reduces its reserves. Notice also how the multiplier effect is still in play, albeit in a slightly different guise. In the previous example, without a reserve bank, gold was the actual reserve, and the banks issued banknotes and checking accounts for that gold. Through fractional reserve lending, they created additional units of so-called book money, which were also represented by banknotes and checking accounts, but which were not backed by gold, but rather by loans. With the introduction of the reserve bank, banks lose their power to issue banknotes themselves, and reserve notes become base money, with gold backing their value. Now banks use their reserve notes and their claims with the reserve bank, that is, their checking account, as reserves of which they only keep a fraction and lend out the rest. So, we started out with gold being levered up using banknotes and checking accounts, and subsequently turned to levering up reserve notes, which are equivalent to gold in this scenario, using only checking accounts. Finally, the reserve bank has the best position to monitor and regulate the reserve ratio of its member banks, so that no single bank can be too reckless on its own. But more on that later. So, let's recap. The reserve bank takes ownership of the gold and provides reserve notes and checking accounts to its member banks in exchange. It therefore increases trust in paper money as a whole, because the fate of banknotes is no longer tied to any one commercial bank. Reserve bank checking accounts provide the means for interbank transfer of funds. The reserve bank regulates reserve requirements and makes lending between banks easier, therefore reducing the risk of bank runs. There is still at least one issue remaining though. Until now we have only discussed bank runs because of liquidity problems due to fractional reserve banking. But what if a bank is actually insolvent because it gave out loans to people who could not repay them? As soon as that bank turns illiquid also, the other banks face a serious dilemma. If they lend additional base money to the bank that made bad loans, they will likely incur losses themselves because they will probably not get repaid. On the other hand, if they let the troubled bank fail, faith in the banking system might falter, and a bank run with all its consequences might ensue. But remember what we said in the beginning about liquidity and solvency. Other banks do not have a reliable way to judge whether a bank in need of liquidity is actually solvent. So it does not even take an insolvent bank for the previously described scenario to emerge. If banks are simply distrustful of one another, an otherwise healthy bank that is just short on liquidity might not be able to find another bank that is willing to lend to it. But before we explore the mechanisms that aim to deal with those remaining issues, and before we close this somewhat artificial gap between a reserve bank and a central bank, we turn to yet another concept, the concept of an elastic money supply. One could argue that another issue with the reserve bank, as it stands now, is that the maximum amount of money is limited by the amount of gold and the minimum reserve requirement. From the perspective of an economy, one might ask why the amount of money should be dependent on something as arbitrary as the available amount of gold. Let's imagine, for example, an economy with 5 entrepreneurs: a farmer, an engineer, a chef, an animal lover, and a drunk. They all have an idea for a project they would like to implement, and they need funding for it. Based on their calculations, they all have a certain return on investment. The farmer is really confident and estimates that he can make 20% on his investment. The drunk, on the other hand, thinks he might be able to make 2%. So, the farmer would be quite happy to take out a loan with a 10% interest rate, while the drunk would only go forward with his bar if he got the money practically free of interest. So, what projects will actually be realized? One could argue that it depends on the amount of money available for investment. The most basic principle in economics is the law of supply and demand. If the supply of a certain good is low and demand is high, the price will also be high. For example, if many people are looking to live in a certain city and there are too few flats available, rents should go up. On the other hand, if there are many empty flats, rents will be low. This is also true for money. If there is a lot of money available for investment, interest rates, which are essentially the rent or the price of money, are low. On the other hand, if there is only very little money available for investment, many people will try to get it and thus bid up the interest they are willing to pay for a loan. So, in this example, if there is very little money available for investment, interest rates might be at 17%. So only the farmer would be able to go forward with his project. And two good projects, the factory and the restaurant, would not be able to get funding at rates that would make them profitable. So even though they are good projects, they would not be realized, which is, one could argue, to the detriment of society. On the other hand, if there is a lot of investment capital available that is hungry for returns, interest rates would be very low, say 1%. So even very marginal projects, like the pet hotel and the hobo bar, would get funding as well. This is bad because it can quickly lead to malinvestments, since an estimated return of 2% leaves very little room for error, and can quickly generate a negative return, therefore wasting resources and destroying wealth, which is also to the detriment of society. So the idea of an elastic money supply is that the amount of money should expand and contract with the needs of the economy, so that good projects are able to get funding, while bad projects, i.e. malinvestments, do not. Notice that I've been calling projects good based solely on their ability to generate a high return on investment, and bad if they promise only a low return and might actually provide a negative return. So, I am not using the words with their typical moral connotation. It might usually be reasonable to expect that financially good projects are also morally good projects. After all, they can only be financially good if enough people are willing to spend their money on them, which in turn should only be the case if people benefit from them in some way. But of course, this coincidence of both goods does not always have to be the case. Now, using this very innocent argument for the need or at least usefulness of an elastic money supply, how could this be achieved using our reserve bank? Let's imagine an economy that has been growing nicely over the years, and for simplicity's sake, no additional gold has been mined. A growing economy means a larger demand for investment capital, but in our current reserve bank system, the money supply has an upper limit, because reserve notes and reserve accounts have to be fully backed by gold. So, in a sense, the most natural way around this problem is to allow the reserve bank to also adopt fractional reserve banking, to allow some monetary authority and control of the reserve bank to grow and perhaps contract the money supply as needed.